The Intelligent Investor by Benjamin Graham is widely regarded as one of the most influential books on investing ever written.
In this video, we will summarize the key takeaways from the book and explain how you can apply Graham's timeless principles to your own investing strategy. From the importance of value investing to the role of patience and discipline in investing, we'll cover the essential concepts that every investor should know. Whether you're a beginner or an experienced investor, this video will provide valuable insights that can help you achieve your financial goals.
Takeaway number 1: always use a margin of safety.
Graham emphasizes the importance of investing with a margin of safety, which means buying stocks or other investments at a discount to their intrinsic value. He believes that by purchasing stocks below their intrinsic value, investors can protect themselves from potential losses and minimize risks. To determine the intrinsic value of a stock, Graham suggests conducting a thorough analysis of a company's financial statements, earnings history, dividend payments, and other relevant data.
By analyzing these factors, investors can make an informed estimate of the company's true value.
Graham suggests that investors should only purchase stocks that are significantly undervalued, ideally by 50% or more, to provide a margin of safety against potential losses. This approach assumes that markets are not always efficient, and that some companies may be undervalued due to temporary factors or market fluctuations. By emphasizing the importance of investing with a margin of safety, Graham encourages investors to focus on the long-term value of a company, rather than short-term market trends or hype. By investing in undervalued stocks with a margin of safety, investors can build a diversified portfolio that is well-positioned to weather the ups and downs of the market over time.
Takeaway number 2: fundamental analysis.
Graham believes that fundamental analysis is the key to successful investing, and that investors should focus on the underlying financial performance and value of a company rather than short-term market fluctuations. He emphasizes that the stock market is not always rational, and that some stocks may be undervalued or overvalued due to factors that are not reflected in their current market price. Fundamental analysis involves examining a company's financial statements, earnings, and other relevant data to determine its true value. By analyzing these factors, investors can make informed decisions about the quality and potential of a company and identify undervalued stocks with significant growth potential. Graham suggests that investors should focus on the long-term value of a company and avoid short-term speculation based on market trends or hype. By conducting thorough fundamental analysis, investors can identify companies with strong fundamentals such as stable earnings, solid balance sheets, and a strong competitive position in their industry.
In addition, Graham advocates for diversification in a portfolio, which means investing in a mix of stocks, bonds, and other assets to minimize risk. By diversifying a portfolio, investors can spread risk across different asset classes and reduce the impact of any single stock or asset on their overall portfolio. Overall, Graham's approach to investing emphasizes the importance of fundamental analysis, long-term value, and diversification. By following these principles, investors can build a strong, diversified portfolio that is well-positioned to weather the ups and downs of the market over time. Takeaway number 3: patience is key. Graham emphasizes that successful investing requires patience and a focus on long-term goals rather than short-term market fluctuations. He believes that the stock market is not always rational, and that short-term trends and hype can lead to overvalued or undervalued stocks that do not reflect their true long-term value. To counteract these short-term fluctuations, Graham advocates for a strategy of value investing, which involves purchasing stocks at a discount to their intrinsic value. This approach requires a thorough analysis of a company's financial statements, earnings history, dividend payments, and other relevant data to determine its true value. Once a stock has been identified as undervalued, Graham suggests holding on to it for the long term, even if its market value fluctuates in the short term. He believes that over time, the stock market will eventually recognize the true value of the stock, and that patient investors will be rewarded with long-term gains. In contrast, Graham cautions against short-term speculation and market timing, which involves buying and selling stocks based on short-term market trends and predictions. He believes that this approach is unreliable and can lead to significant losses for investors. Overall, Graham's approach to investing emphasizes the importance of patience, long-term thinking, and a focus on the underlying value of a company rather than short-term market fluctuations.
By following these principles, investors can build a strong, diversified portfolio that is well positioned to weather the ups and downs of the market over time.
Takeaway number 4: Diversification. Graham believes that diversification is a key component of successful investing, and that investors should avoid putting all of their eggs in one basket by spreading their investments across multiple stocks and asset classes. The reason for diversification is to minimize risk, as investing in only one stock or a few stocks can expose an investor to significant losses if any one company underperforms or fails. By diversifying their portfolio, investors can spread risk across different industries, asset classes, and geographies, reducing the impact of any single stock or asset on their overall portfolio. Graham suggests that investors should focus on a mix of stocks, bonds, and other assets, such as real estate or commodities, to achieve a well-diversified portfolio. He recommends a minimum of 10 to 15 stocks to achieve adequate diversification, with no more than 10% of an investor's portfolio invested in any one stock. In addition, Graham suggests that investors should avoid trying to time the market or chase short-term trends, and instead focus on a long-term investment strategy. By investing in a diversified portfolio of stocks and assets with a long-term horizon, investors can avoid the temptation to make impulsive, emotional investment decisions based on short-term market fluctuations. Overall, Graham's approach to diversification emphasizes the importance of minimizing risk and avoiding overconcentration in any one stock or asset class. By diversifying their portfolio and maintaining a long-term investment strategy, investors can achieve steady, consistent returns over time while mitigating the risks of investing in the stock market. Takeaway number 5: Avoid emotional decision-making.
Graham believes that emotions can cloud an investor's judgment and lead to impulsive investment decisions based on fear or greed. He argues that successful investing requires a disciplined, rational approach that is guided by a well-defined investment strategy rather than emotional impulses. To avoid emotional decision-making, Graham recommends that investors develop a clear set of investment principles and stick to them consistently over time. This includes having a well-diversified portfolio, avoiding excessive speculation, and maintaining a long-term investment horizon. In addition, Graham suggests that investors should remain detached from the short-term ups and downs of the stock market, focusing instead on the underlying value of the companies in which they invest. He recommends conducting thorough fundamental analysis to identify undervalued companies and avoiding the temptation to chase short-term market trends or hype. Overall, Graham's approach to avoiding emotional decision-making in the stock market emphasizes the importance of discipline, rationality, and a long-term perspective. By sticking to a well-defined investment strategy and avoiding impulsive decisions based on emotions, investors can achieve steady, consistent returns over time while minimizing the risks of investing in the stock market. Thanks for watching this video on the key takeaways from The Intelligent Investor by Benjamin Graham. We hope you found this summary helpful in understanding the key principles of value investing and developing a sound investment strategy.
Remember, investing is a long-term game, and patience and discipline are key to achieving success. Keep learning, stay focused, and make informed investment decisions based on thorough research and analysis. Don't forget to like and subscribe for more insightful videos on finance, investing, and other various things. Goodbye.